In the first quarter of 2020, markets were broadly lower. The U.S. benchmark index, the S&P 500, was down nearly 20%. Small cap stocks were down more than 30%. Smaller companies, which generally have less cash available and are often not yet profitable, are underperforming in this economic shutdown environment. International developed and emerging market indices were down slightly more than the S&P 500. Bond investments, as represented by the Barclays Intermediate Government Credit and Municipal Indices, fared better as investors flocked to these relatively safer investments amidst the anxiety in the markets. From a sector perspective, energy was the worst performing, down over 50%. Most energy companies trade based on the price of oil, which was down significantly in the first quarter. In addition to the drop in demand for oil given the coronavirus shutdown, a price war between Saudi Arabia and Russia exacerbated an oversupply that drove down the price of oil to record lows. The financial sector was the second worst performer in the first quarter as interest rates declined broadly. Financial companies, such as banks, typically earn interest on loans to companies and consumers, and so their margins are squeezed when interest rates are low. Large banks also needed to set aside substantial amounts of money to prepare for a wave of defaults on loans outstanding, as many of their debtors could have trouble making payments. Technology was the best performing sector, as many of these companies' business models are somewhat insulated from the effects of the shutdown. Large technology companies in particular have strong balance sheets and may even stand to benefit from trends such as stay at home, work from home, and contact tracing. Healthcare outperformed as many pharmaceutical companies went into overdrive, developing treatment and vaccines for COVID-19. Consumer staples also held up relatively well. This defensive sector benefited from increased demand for essential products such as toilet paper. A bear market is defined as a decline of 20% or more. In the first quarter, we witnessed, by far, the fastest bear market in history. From the S&P 500 peak on February 19th, it took only 21 trading days to enter bear market territory. This was twice as fast as the crash in 1929, which was the start of the Great Depression. As news outlets reported that the virus was spreading around the globe, markets began to gyrate wildly. This chart shows the daily percentage price change of the S&P 500 in the first 3 months of the year. After very little volatility in January and February, by mid-March, nearly 10% daily swings in both directions became the norm. In fact, March of 2020 was the most volatile on record. The average daily price change for the S&P 500 was 5.3% in March. The majority of the time, this index moves less than 1% per day. With the currently unknown timeline to resolution to both the healthcare and economic crises, the estimates that economists put out for second quarter GDP have an enormous amount of variation. This box and whisker chart shows that while previous estimates for Q2 GDP ranged from up slightly to down about 12%, current estimates reflect a range from up slightly to down more than 50%. The COVID-19 pandemic has been especially disastrous for certain industries. The retail, restaurant and bar, entertainment, transportation and hotels, and tourism industries are particularly vulnerable. These industries make up 19% of GDP, 20% of payroll jobs, but only 7% of operating earnings in the S&P 500. Of course, other industries outside of these will also see their earnings impacted from this pandemic, but the decline may not be as dramatic as the impact to GDP and jobs. This line graph shows the year-over-year growth in the number of total U.S. jobs. The red horizontal line marks the 1% level, and the vertical shaded bands indicate recessions. We track this number because the year-over-year job growth number has fallen below 1% prior to every recession since the 1980s. As the pandemic hit the U.S. in early March, companies began laying off workers at an unprecedented pace. This caused the job growth number, which had been 1.5% prior to March, to drop quickly to the 1% threshold. In response to the pandemic, Congress passed a $2.3 trillion stimulus package that was signed by President Trump. This is roughly 13% of total U.S. GDP and is about 4 times the size of the stimulus that was passed in the wake of the financial crisis in 2009. In addition to providing one-time checks to households, the stimulus was aimed at supporting small businesses through the shutdown. The top right figure shows historical and projected federal budget surplus and deficits. The bottom right chart shows federal net debt over the past 70 years, as well as the projections for what net debt is expected to look like over the next 10. This was one of the fastest actions by Congress in response to a crisis. The Federal Reserve also stepped in with a new round of stimulus measures aimed at backstopping liquidity during this turbulent time. The Fed cut rates back to 0%, restarted their asset purchase programs in unlimited capacity, and relaunched certain liquidity facilities that were set up during the financial crisis. This chart shows the Fed balance sheet total over time. Looking back to 2008, in response to the financial crisis, the Fed instituted 3 quantitative easing bond buying programs, which expanded its balance sheet from $900 billion to $4.5 trillion. Over the past few years, the Fed had begun to let some of these maturities roll off in an effort to reduce the size of the balance sheet. However, once the market started to see liquidity issues, the Fed quickly reversed course and began adding to the balance sheet. As a result of current stimulus measures, the Fed has added over $2 trillion to their balance sheet since last year. The current balance sheet total of nearly $6 trillion dwarfs the previous record. While we think this stimulus is necessary to support the economy in the short term, we worry longer term about what other impacts it could have and how it will all be unwound. At the height of the market panic in March, we witnessed a transition from a flight to quality to a flight to cash, as investors placed a premium on liquidity. As a result, the bond market saw significant disruption. This chart shows corporate BBB and municipal AAA 10-year yields since the beginning of this year. Bond prices and yields move inversely, so these large spikes on this chart correspond to a drop in price for both. This disruption stabilized at the end of March once the Fed stepped in to backstop liquidity. A yield curve is a graphical representation of yields at various maturities. This chart shows the U.S. Treasury bond yield curve from 1 month to 30 years. The orange line is the yield curve as of December 31st, 2019, and the blue line is the yield curve as of March 31st, 2020. Rates dropped across the board in the first quarter as the Fed cut their benchmark rate and investors flocked to the relative safety of bonds. The blue line on this chart represents the yield on the 10-year Treasury from 1958 to present. The gray line shows the real rate of return, which is the nominal 10-year Treasury yield minus inflation, calculated as Consumer Price Index, or CPI. For example, on the 31st of March, the 10-year Treasury offered a 0.7% nominal yield, which, given inflation of 2.37%, equates to a real yield of negative 1.67%. Real yields have been falling over the last decade, and at the end of the first quarter, they settled in at a multi-decade low. With real returns in negative territory, we do not see compelling return in the bond market. This chart shows the trailing price-to-earnings ratio for the S&P 500. This measure generally gives us an idea of whether stocks are expensive or cheap. The trouble with utilizing this metric right now is that we have no idea what earnings will look like going forward. Until we know how long the shutdown in the economy will ultimately last, or how long it will take to fully control the coronavirus outbreak, earnings estimates are simply a wild guess. As a result, the earnings, or E in the PE ratio, is really a big question mark at this point, and so we do not have an accurate valuation measure. Looking ahead, we believe volatility will continue as the market digests the economic impact of the pandemic. The ultimate severity and duration of this economic downturn depends on an unknown future timeline for which data is not available. We worry longer term about how monetary and fiscal stimulus will be unwound.